are you thinking about stimulus? When, how much, and what to do about it?
Well, what you see today is a little bit of the recovery trade. But if you step back, we would argue that now's not the time to be a hero. You know, we continue to believe in the recovery trade, but we expect a bumpy ride due to politics and pandemic. And the pandemic is still very much on the market's radar, even though today growth stocks are underperforming. You know, as asset allocators, a key part of our process is to formulate a risk-on versus risk-off view. And in the short run, the election outcome will drive risk-on versus risk-off sentiment. But we've not eliminated election tail risks, and the risk of a contested election is still there. So you have also, though, as an asset allocator, to worry about COVID on versus COVID off. And typically, the recovery trade has been associated with COVID off. You need to get rid of this health crisis in order for the economy to fully recover. So the bottom line is that in this environment with politics and pandemic, we would argue not to be a hero, to stay diversified between stocks and bonds, not take large positions. On the margin, we would be long the recovery trade.
So I'm just trying to parse your words and figure out what that means to typical investors. Usually, I mean, if you want to be long the recovery trade, you buy stocks. And if you want to diversify to prepare for the bumps in the road that you mentioned, you'd buy bonds. But that really hasn't worked out. Bonds haven't protected you in that kind of way. So what should investors do?
Right. Bonds aren't as good a diversifier as they used to be. And we've just seen this in September. The market went down 9% and bonds actually went down. So you have to take that into account. The way to position for the recovery trade, I think, is to not be a hero and be neutral between stocks and bonds at the top level, because if you think that stocks are expensive, bonds are even more expensive. However, under the top level, there are ways to be long cyclicality while taking advantage of attractive relative valuations. You saw small caps do well today. Small caps relative to large caps are down 11% year to date. You've been talking on your program a lot about value versus growth. Value is down 33% year to date relative to growth, and we're starting to dip into value. So because of all the uncertainty and this bumpy ride ahead, you don't need to take a lot of risk in stocks. But under the hood, how you allocate your stocks, you can take advantage of cheap cyclicality, small caps, emerging markets, a little bit of value stocks, and some credit, high yield bonds, for example.
Shepard Smith here. Thanks for watching CNBC on YouTube.